The Trump tariffs could help prevent another Great Depression by bringing China to the table to talk currency. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today we're going to be talking about China and the Trump trade talks with China, and what it's going to take to get China to the table again to talk currency and to talk about the yuan being artificially pegged to the dollar at a very cheap rate, about 60 yuan per dollar, and it's been that way for many, many years. China entered the WTO in 2001, and in that time, they've managed to dramatically increase their global manufacturing market share. The trade and good deficit with China hit its all-time high in 2018 at 419 billion. That was up from 2017 at 375 billion. And this has come as China has dramatically increased their global manufacturing market share from about 5% in 2001 to 16.6% in 2017, according to World Bank data. In the meantime, U.S. manufacturing market share dropped from 13% to 7.5%. So we've been seeing a shift of production overseas, particularly to China in manufacturing. Again, China severely depreciated its currency back in the mid-90s and have left it artificially pegged below the dollar. At that point, it was about 8 yuan per dollar. Right now, it's about 6 yuan per dollar, but it's still artificially cheap. In that time, they managed to dramatically increase their global manufacturing market share. They were able to appreciate it, particularly after the financial crisis, let it float a little bit, but it's still pretty well pegged below the dollar there. And so that's giving China pretty much an absolute advantage on prices by having artificially low currency vis-a-vis the dollar. It makes their exports cheaper. It makes imports to China more expensive. So it's like a huge it's like a tariff, and it's also like a subsidy. Again, it makes their exports cheaper and their imports more expensive, and so it's definitely it's not a tariff by name, but it's a non-tariff barrier, and it's something that should come up in the U.S.-China trade talks. And I think there's good reasons historically for this to come up. A long-standing conventional wisdom is that the Smoot-Hawley tariffs in 1930 were somehow made the Great Depression much, much worse. And it wasn't until the 1934 Reciprocal Trade Act that began to lower the tariffs that the recovery was possible. But this is really a caricature of what was really going on at the time. It wasn't the tariffs that caused the Great Depression. It was deflation. I mean, you can see an example of this caricature on history.com, and it doesn't even mention deflation being a problem. It just simply talks about trade and the Smoot-Hawley Act and then the Reciprocal Trade Act, as if these were the only things that mattered in the Great Depression. The article doesn't even mention unemployment, which should tell us a thing or two here. But deflation, on the other hand, I believe is far more causative of the problems that we were seeing in the Great Depression. If you look at this chart here, you can see that as the deflation was taking hold, that's a negative inflation rate. The unemployment rate was rising dramatically. This was a huge problem, particularly in the United States. But the deflation began after World War I and the ensuing credit expansion. It printed a lot of money to pay for the war. It had a brief respite in the 1920s, but began happening again in 1927. It slowed in 29, but things went crazy in 1930 as banks began failing. So inflation was marked at negative 2.7% in 1930, negative 8.9% in 1931, negative 10.3% in 1932, and then negative 5.2% in 1933. And in the meantime, the unemployment rate skyrocketed. It was up to 11% by the end of 1930, up to 19% by the end of 31, up to 25% by 32, and it peaked in 1933 at 25.4%. That was at that point that Franklin Roosevelt, president at the time, ended the interwar gold standard, and then finally some relief was being felt. You could see the unemployment rate was dropping Thereafter, the dollar was too strong, and frankly, developments overseas may have played a big role in ensuring that reality. You had an uneven history of countries leaving the gold standard during this period. It began in the late 20s. The UK came off of the gold standard in 1931. They had a huge problem with deflation too after World War I. Unemployment rose to 11% in 1921. It dropped slightly, and then was back by 1930. Was up again, back up to 11%. So they left the gold standard pretty quickly, and then unemployment peaked at 15% in 1932 before slowly coming back down. And if you look at an article, a paper from economists Barry Eichengreen and Jeffrey Sachs, exchange rates and economic recovery in the 1930s, you can see that the unemployment came down quicker in countries that left the gold standard first. This was a paper from 1985. And so let's look at what Eichengreen and Sachs observed. They said, quote, in all cases of unilateral devaluation, currency depreciation increases output and employment in the devaluing country. By raising the price of imports relative to domestic goods, depreciation switches expenditure towards domestic goods. The increased pressure of demand will tend to drive up domestic commodity prices, moderating the stimulus to aggregate demand, and by reducing real wages, stimulating aggregate supply until the domestic commodity market clears. The same effect switches demand, of course, away from foreign goods and exerts deflationary pressure on the foreign economy. So the UK left the gold standard in 1931, and so that could have had a ripple effect throughout the global economy and exerted more deflationary pressure on countries like the United States. So if you note that in 1931, when they came off the gold standard, the UK, that was the same year inflation in the US went from negative 2.7% to negative 8.9%, and the unemployment rate went from 11% to 19%. So a good question might be what impact the UK's devaluation in 1931 and other countries who were leaving the gold standard at the time had on the United States. Did it worsen the Great Depression? What we do know is that the United States did not leave the gold standard until 1933, and it was at that point that deflation started to come down and then the unemployment rate began to come down. Now, the Reciprocal Tariff Act was also implemented in 1934, and this would have had an impact upon the tariff rates that were being charged by the United States. And you can see the chart here. I'll probably have to zoom out a little bit here. So you can see right there, prior to the Smoot-Hawley Act, we were charging an effective tariff rate of about 40%. And then in 1930, it went up to 60%. And then after the Reciprocal Trade Act, it began coming back down, and that back down to its pre-depression point of about 40%. So that's still pretty high. And we've noted on this channel previously that there was a double dip recession, and that it didn't occur because the tariffs were still in place. It happened because deflation started happening again. In 1938, you had a consumer price index reading of negative 2%, and then the economy dipped back into recession. The unemployment rate again jumped up to about 20%. And this all continued until World War II onset. And then in the United States, we began conscripting people into the draft towards the 40s, and then the unemployment rate dropped dramatically. Inflation started taking off. U.S. exports, supplying allied nations, and then joining the war. We shifted away from a peacetime economy to a wartime economy, so we weren't exporting goods and services per se. We were exporting bombs and munitions and tanks and building our Navy and Air Force. And so And that's the kind of the experience there. The world it really didn't end till World War II, but deflation was your primary driver of unemployment and the recession or the depression, the negative growth that was being experienced. The deflation is a terrible thing. It results in prices dropping across the board. So if you're a business and you're trying to sell goods and or services and the prices are constantly dropping, well, that means you're going to lose money. It might have cost you $10 to bring it to market, but suddenly you can only sell it for $9. So while that was happening, the prices were dropping. There was debt deflation from the credit expansion in the 1920s, and you had a ton of bank runs, and then the current and plus the global monetary system was collapsing. Other countries were coming off the gold standard, and that was like rocket fuel for the depression in the United States. By 1932 and 1933, we were getting up to 25% unemployment. It was a human catastrophe. The Great Depression was, and the interwar gold standard appears to have played a major role. Now, here, Eichengreen and Sachs describe what happened after the U.S. Or when the U.S. came off of the gold standard. First, quote, we restricted foreign exchange dealings and gold and currency movements, and the following month, Roosevelt issued an executive order requiring individuals to deliver their gold coin, bullion, and certificates to Federal Reserve banks. From this point on, the dollar began to float. By setting a series of progressively higher dollar prices of gold, the administration engineered a substantial devaluation. When the dollar was finally stabilized in January of 1934 at $35 an ounce, it retained but 59% of its former gold content. And then we saw, again, the unemployment rate was dropping almost immediately. Now, this was definitely a competitive devaluation by the U.S. Other countries had already left the gold standard, so we were trying to reach equilibrium, and it certainly helped by undergoing a devaluation. Again, the problem wasn't the gold standard per se. The interwar gold standard was a big problem, though. It was different than the classical gold standard, and we'll come to that here. There was another paper by Eichengreen and this time Chris Michener, this time in 2003, The Great Depression as a Credit Boom Gone Wrong. And it focuses on how credit expansion after World War I and during the 1920s contributed to the Great Depression. And they look at the quote, focusing on the credit boom of the 1920s directs attention to the role of the interwar gold standard in setting the stage for the slump of the 1930s. Our analysis suggests that equally pronounced credit booms were not a facet of the classical gold standard. The amplitude of credit fluctuations appears to have been less under the pre-1914 gold standard than under more flexible exchange rate regimes that followed. Evidently, however, the interwar gold standard was different. Quote, the strongly pro-cyclical behavior of the foreign exchange component of global international reserves and the failure of domestic monetary authorities to quickly install stable policy rules to guide the more discretionary approach to monetary management that replaced the more rigid rules-based gold standard of the earlier era are important for explaining the fragilities that set the stage for the Great Depression. And they talk about their prior work. That, quote, has emphasized the role of the interwar gold standard in the post-1929 collapse of foreign exchange reserves and money supplies and in the international transmission of destabilizing impulses. But the credit boom view suggests that the structure and operation of the interwar gold standard also played a role in the expansion phase, when the endogenous response of the foreign exchange component of global reserves allowed credit to expand more rapidly than would have otherwise been possible under traditional gold standard arrangements. This is an important extension of the conventional gold standard and Great Depression story. So basically, you had a huge credit boom after World War I and during the 1920s. A bunch of money was printed, and then there wasn't enough gold to satisfy all of the dollars and all of the pounds that had been made overseas. If you look at UK inflation, you can see in For example, 1915, they had 12.5% inflation, 18.1 inflation percent in 1916, 25% inflation in 1917, 22% in 1918, and then prices started stabilizing. But they had a huge deflation throughout the 1920s, starting in 1921 at 8.6%, negative 14% in 1922, negative 6% in 1923. And as that happened, the unemployment rate in Great Britain was skyrocketing. It got up to 11% in 1921 before it started to come back down into the 7% range. And then in 1932, when deflation started in the Depression again, it peaked at 15.4%. By then, they were off the gold standard, and then the prices began drop. The unemployment rate began dropping as prices stabilized and inflation was able to take root again. Again, as Eichengreen and Sachs noted in their paper, this was the countries that came off the gold standard, the interwar gold standard, the one that allowed this credit boom to take place. The ones that did that first, they experienced economic recoveries much faster than countries like the United States, which waited to come off the gold standard. And the year UK came off the gold standard, it could have had a deflationary impact on foreign economies like the United States, and then unemployment jumped up the wazoo. And so if anything worsened the Great Depression, it was the competitive devaluations which occurred unevenly. If they had all occurred at the same time, it could have had much more of a stabilizing impact. And so when you get to the issue of tariffs, you can look at the Smoot-Hawley in 1930, but perhaps we should look at 1932. A year after coming off the gold standard, the UK implemented a pretty hefty tariff. And that it was called the Import Duties Act of 1932. And what it essentially raised taxes on imports. But did it have a retaliatory impact, or did it hurt the UK after they? Yeah, I mean, tariffs are supposed to make the Depression worse, right? Well, they did it in 1932, but the unemployment dropped from 15% in 32 to 14% in 33 and 11.7% in 1934. So they came off the gold standard, and the unemployment starts coming down. They implemented a tariff, and the unemployment rate was still coming down, and they were experiencing a recovery. So the problem wasn't the tariffs, it was the deflation, and curing the deflation helped things to get back to normal. Again, if you look at the average in tariff rates that the U.S. was charging pre-Smoot-Hawley, during Smoot-Hawley, and then after Smoot-Hawley during the Depression, we went from 40% to 60% under Smoot-Hawley and back down to 40% in the mid 1930s. And so having a 40% tariff rate still fostered conditions that allowed for unemployment to drop. By 1937, it was down to about 11%. So I don't think tariffs are what was causing the unemployment rate to go up in the first place. And the fact that tariffs remained in place, the fact that the UK did tariffs, that didn't stop unemployment rate from dropping or from the economy and growing again. That was the coming off the interwar gold standard and depreciating the currency and allowing the inflation to again go into positive territory. And then, economic animal spirits can take root again. Suddenly there's a profit motive. Businesses will make money when they sell goods and services. And so people started getting back to work. And that's what I think that's really the history here. And I think Eichengreen and Sachs, and also the later paper with from 2003, they show that the credit expansion and fostered after World War I during the 1920s created big inflation that could then or expansion of asset prices, as in the case of the United States. You had a lot of stocks bought on margin in the late 20s, and then the whole thing came crashing down, and the banks started failing. So, and if you look at the foreign trade of the United States, a CQ researcher report, it notes that in 1930, what were they looking at when they were enacting Smoot-Hawley? Well, the value of imports was dropping faster than the value of exports. which you'd expect in deflationary circumstances. So all prices were dropping, but the relative to imports and exports, import prices were dropping even faster. So it would appear that policymakers misdiagnosed what the problem was. They say, oh, import prices are dropping even faster than export prices. Therefore, if we do a tariff, that will stop the pain. But really, it was an exercise in futility. The tariff on its own was not going to address the deflation that was occurring, which the root cause for inflation or deflation is always monetary in origin. In this case, it was the monetary policy that the Federal Reserve and other central banks around the world were pursuing. And then when other countries came off the gold standard, that had an even bigger deflationary impact upon the United States. So now after World War II, this was all resolved. With an international monetary accord, you had the Bretton Woods system. You also had GATT, which was implemented to help reduce tariff levels. And by cooperating on currency and on tariffs, we were able to bring the general tariff and non-tariff barriers down. And then you had stable price stability, which is really should be the goal of monetary policy and international trade. And then the economy grew, and that system stood pretty good in place until 1971, when the U.S. gold reserves were being depleted by France. Richard Nixon ended the gold exchange at the Federal Reserve, and that set off the great inflations of the 1970s. It was another devaluation. One can argue whether it was necessary or not. But I think there we learned what the limits of currency devaluation are, where if you do it too much, if you're not in a deflationary standpoint, then you could see prices rise dramatically. And we did see that inflation got out of control, interest rates rose dramatically to compensate, and unemployment rose. So just because deflation accompanied high unemployment during the 1930s, did not policymakers thought, oh, well, inflation can't hurt. We can't have any problems there. But you saw high unemployment in the 1970s as well. So after inflation was stabilized in the 1980s, arguably we had price stability once again. The economy was doing well in the 80s, and after the 91 recession in the 90s, all was doing well until China entered the WTO in 2001 with their unstable, artificially cheap fixed exchange rate. And we've looked at this. The fact is that they depreciated their currency very much so in the mid-90s. They entered the WTO, and then it's like rocket fuel. They can increase their global manufacturing market share. The U.S. lost global manufacturing market share. The economy hasn't grown above 4% since 2000, not above 3% since 2005. We got to 2.9% in 2018. We're at 3.2% now with Trump's policies being implemented in the first quarter of 2019. Fingers crossed we get above 3% this year. Maybe we will, maybe we won't. But we do need to address, I think, these currency distortions that China is now causing today. Because recall from the Eichengreen and Sachs paper on devaluation, quote, the same effect of devaluation switches demand away from foreign goods, in this case China, exerting deflationary pressure on the foreign economy. So China's one of our largest trading partners. You could look at Mexico too. They devalue the peso to gain trade advantage, and it has an impact, and it may be exerting deflationary pressure on our economy even today. And I think that we need to address that during the trade talks. That's absolutely necessary to get the situation under control. But the bottom line here is that the tariffs on their own did not cause the Great Depression. And I believe personally that their role has been overemphasized in some of the literature. I believe deflation brought on by the weak interwar gold standards played a far more critical role. The tariffs in 1930 might not have helped, and we can admit that. But in themselves, I don't think and they don't necessarily set off retaliatory cycles. So if you look at the UK tariff of 1932, that was followed by the U.S. enacting the Reciprocal Trade Act in 1934. So we actually managed to, because maybe because of the retaliation on the previous tariffs, we said, oh, wow, maybe we can reduce tariffs now. So sometimes tariffs can provoke a conversation, in this case, the Reciprocal Trade Act. And today, Trump is enacting a 25% tariff on 250 billion of Chinese goods. But I think that's simply to get China to the table. The tariff is probably an imperfect tool. China can devalue the currency even further to offset it, but it hopefully gets them to the table. An alternative would be perhaps devaluing the U.S. dollar, which would, I presume, drag the further devalue the yuan, and it might provoke domestic inflation in China. That's an alternative, but it might have huge distortionary impacts. It's probably better to talk it out and to let China know what their monetary policy does to the world. Their fixed exchange rate, 6 yuan to the dollar, or wherever they set the peg, could be having huge deflationary impacts upon the global trading system and the global economy. When this happened in the 1930s, when you had these types of competitive devaluations, it could be like rocket fuel for the other countries where unemployment can go up really high. Deflation can take root. One thing I think we might want to look at and could bear further study is whether the global shift in production towards China in the 2000s played a contributing role in the Great Recession of 2008 and 2009. It could have. I think that economists. I'm not an economist by trade. I studied political science, but we can read charts and we can look at numbers and we can start to draw conclusions about what's going on here. I think that China's monetary policy is dangerous for the global economy. And it could be dangerous to China. The fact is, they depend on exports, and if the rest of the country, all the other countries, if they're going to experience deflationary pressures, I mean, we had the housing market crash in 2008 and 2009, and coincidentally, that's when China let the yuan begin to float a little bit, and probably because with the deflation in the U.S. And the economy contracted, that would make their currency too cheap, and it could have been promoting domestic inflation, so they let it appreciate a little bit. But they were still able to maintain, I think, their cost advantages in manufacturing because the peg is still artificially cheap compared to the dollar. So Trump's using tariffs, I think, as a mechanism to get China to the table. Again, we need to talk this out. Trump he's using the art of the deal. You have to use your leverage. There is some urgency insofar as nobody can predict when the next recession will hit. But sitting around and waiting and hoping that China's monetary policy won't have the same global distortionary reverberations that such policies have had in the past seems folly. I mean, China's economy is the second largest in the world. Of course, it's going to have an impact. If tariffs are supposed to have an impact, I think these distortionary monetary policies can similarly have an impact. And I'll leave you with the end here. The important part is this story does not need to end the same way as the 1930s. Regardless of politics, we should all hope that President Trump succeeds in his negotiations. We need a reciprocal agreement with China. The root cause is the yuan's pegged to the dollar, which makes the dollar too strong versus the yuan and the U.S. less competitive. In the trade talks with China, currency must be brought front and center for U.S. negotiators before it is too late. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. That's the commentary. Hit the subscribe button and have a great day.